Let's welcome in Pankaj Murarka now, CIO at Renaissance Investment Managers, is now with us. Pankaj, thanks for taking out time for us. Could you just talk to us about what's happening in the markets? What suddenly changed the sentiments the way they have in the last 5-6 days?
Well, good afternoon, Pankaj. I think the world has changed over the last few days, especially over the last week, because essentially, while all of us clearly were seeing that the Fed was very aggressive in raising rates because they were significantly behind the curve, I think what was not the base case was eventually playing out as some tail risk, with essentially collapse of a couple of banks and significant concerns out there on a lot of smaller banks in US. Essentially, the tail risk which exists in the US ecosystem have come to the forefront now. And I'm sure there's been a lot of nervousness around that. So, and I think the sum total of reaction of the market is nothing but factoring all these concerns. I think the good thing is at least the regulators have acted very promptly in terms of whatever they've done, trying to reassure depositors and making sure that there's no run on the system. Otherwise, meaning there would have been a massive run on all the small banks out there in US. So I think it'll take some time for all of this to settle down.
Right. Pankaj, since you track IT very well, and I was chatting with the previous guest as well about it, a lot of concern around, some of these key IT names and largely the mid-cap ones, which do business with US banks. You think the concern is valid? I mean, the IT index itself has fallen the most since like December 15th. It's 5% down in just the last 5 trading sessions.
I think it's too early to take a call, Aisha, but my understanding is that I don't think so Indian IT companies will get impacted because if what we are seeing in US is essentially there's a flight of deposit from smaller banks, essentially that money will go back to larger banks. And all these top 10 large banks of US essentially are customers of Indian IT companies. You talk about JP Morgan, you talk about Wells Fargo, you talk about Bank of America or Citi, they're all customers for Indian IT companies. So I don't think so that it has a meaningful impact, at least from the information or what we're seeing is playing out in the US. Having said that, we can always create a case that US economy goes into a deep recession and there's a complete freeze out there, which is at least not our base case. So I don't think so for the time being, I see a meaningful impact on business IT companies. Well, as far as stock price reaction is concerned, that's a knee-jerk reaction or the nervousness that's playing out in these stocks. Also, I think given the volatility and news flow, there's a fair bit of retail capitulation that's happening out in markets.
Pankaj, stay with us. Lots more to discuss with you. For now, we're going to take a very quick break. But the news is that we've seen an over 100-point recovery from the session lows. We're down only 90 points right now. And I say only because it was a lot worse just about an hour or so back. We'll come back with more.
Welcome back. Pankaj Murarka is still with us. Pankaj, when we just talk about what's happening globally, do you think Fed, the stance that they take, whether they look at QT or halt the QT, will all be particularly very important now?
Well, yes, it does become important, Pankaj. I think it's too early days. We are just about 3 or 4 days into this whole event. So I think the bigger risk now really is that now that the tail risk have actually started playing out in the US economy is that as far as this risk is concerned, the central banks have contained this. But the big question mark out there is whether it leads to a contagion or not. All of us understand that US is a highly leveraged ecosystem. In a leveraged ecosystem like US, where you have $40 trillion of debt outstanding, if you increase interest rates by 450 basis points over a period of 15 months, it's going to have repercussions. So, which is what exactly we've seen. The question now out there is that whether it remains constrained to this or we see a contagion out there. And I think the bigger risk this time around is in the private credit markets in US, because those are markets which are completely unregulated with no oversight from US Fed. And we have seen significant growth in private credit in US over the last 10 years of the QE era. So I think for the timing, I think this fallout does move Fed to move a bit slower than what was expected. Probably I think when they meet on 27th and 28th of March, instead of 50 basis points, I still think a 25 basis points rate hike is still on the table because the fact remains that inflation still remains persistent in US. So I think this move will force the Fed to go a bit slower on that. But let's see how the whole thing plays out.
The financial turmoil that it is creating, don't you think they would be, I mean, what they comment on that would be important because that will decide the future course then?
Absolutely, but also as I said, the fact remains that inflation in US has been persistent and has been very sticky. The big question mark out there is while certain part or portion of that inflation is cyclical in nature, the concern out there is some part of inflation in US are structural in nature and that has emerged out of the last 15 years of quantitative easing. So you cannot moderate structural inflation which has emerged out of 15 years of quantitative easing or free money in a matter of 15 months. You need to give it time. So the challenge today the Fed faces is on back of almost 15 years of quantitative easing, they kept extra loose monetary policy for a fairly long period of time post-COVID. And now they want to unwind all of that excesses in a matter of 15 months or 18 months, which cannot happen with a soft landing. If you want to unwind what you did in 15 years in a matter of 18 months, you're going to create accidents, and which is what we are seeing now. Now the question is how much, how much the Fed is capable of taking or witnessing before they change their stance. And I think they'll change their stance sooner rather than later because they don't have ability to withstand all of this weak economic data or economic collapse for a long period of time.
Okay, Pankaj, great to have you on the show. We'll let you go on that note. Understand that you have a hard 3 p.m. cutoff is what we were told. Okay, we'll take a very quick break. But before we do that, let's also get you some closing ideas going. Kunal, on your list?
So I'll continue to go into a bit of a mixed stance over here. So the trade which I'm initiating at current levels would actually be to buy on UBL. That's a stock which I think has formed a bottom at the 1430, 1440 mark. So United Breweries is a stock which seems to have bottomed out, more or less in line with what's happening with United Spirits as well.
Right. Naresh, what about your closing ideas?
So initiated a buy on Balrampur Chini, a fresh one. It's finally some bit of a dip which was needed after that move. So at 390.95 looks like a good entry point. Would be looking to add more going forward at 410 or at 385.
Very quick break on that note. BPCL, Titan, IndusInd Bank, Bharti, ICICI Bank, L&T, Axis. They're the ones which are leading the recovery for the index as of now.